Hello. In this video, we'll continue our corporate tax discussion and we'll focus on corporate redemptions. So remember, whenever you focus on corporate taxation, it's important to remember the big picture, where everything fits into place. Remember the life cycle of a corporation. We start with corporate formation and contribution. Then we also consider funding, capital funding, whether it's debt versus equity. We then talk about the normal operations, various little provisions, also dealing with distributions and redemptions, which normally occur during the normal operations. Finally, we wind up the business liquidation. So we're focusing on corporate redemptions. So you're wondering, what exactly are the tax issues related to corporate redemptions? So let me pose to you a simple example. Let's say we have an individual. The individual is Blueberry. Blueberry owns 100% of Fruit Tree Corporation. Okay, 100% of Fruit Tree Corporation. So I have denoted here that Fruit Tree is a corporation by being a rectangle. So Blueberry, B, also got the blue Keller, 100% owner in Fruit Tree Corporation. You might recall from the distribution videos that we've been doing, Fruit Tree, if Fruit Tree makes a distribution to B, okay, let's say Fruit Tree makes a $1 million distribution, $1 million in cash, $1 million cash distribution from Fruit Tree to sole shareholder B, Blueberry. So Fruit Tree on the Form 1120, we're assuming this is a C corporation, on the Form 1120 has to pay tax. When that distribution takes place from Fruit Tree to Blueberry, there's a second level of tax that Blueberry has to pay. And that's a function of how exactly that distribution will be determined, will be treated under the tax law under Section 301, the distribution rules. So to the extent of earnings and profits, it'll be a dividend. If there's not enough earnings and profits, the remainder, or the next part of the waterfall is return of capital. And then finally, whatever's left over goes to capital gain distribution. So when we're thinking about the distribution rules, right? When we think about those distribution rules, again, we have the three-part waterfall, right? The first stop on the waterfall is dividend treatment. Second stop is return of capital, which return of capital just simply reduces basis and it's not taxable to the actual shareholder. And finally, whatever's left over is going to be a capital gain distribution. So that could be whatever's left. Capital gain distribution. When it comes to the dividend, I'm going to focus in on the dividend. The rules for dividends are ordinary income. Dividends are ordinary income. So Blueberry would have to include dividends on Blueberry's Form 1040 as ordinary income. Now, at the time of this video, and for a few years now, dividends, if they're qualified dividends, there's some special rules, okay? Qualified dividends have special rules. Specifically, they get these long-term capital gains preferential rates. The long-term capital gains preferential rates, which at the time of this video, and this could change, this changes all the time, so you got to be careful, get the long-term capital gains rates. At the time of the video, 20% is the highest long-term capital gains normal rate. There's special rates for collectibles under Capture Section 1250, but for qualified dividends, we're talking about long-term capital gains rates, maximum rate of 20% currently. But what happened before qualified dividends had this special characterization? So before, because this is not, when you look at the history of the income tax law, the qualified dividend rules, those weren't always around. So again, ordinary income, if we didn't have the qualified dividends rules, so let's cross that off. So we're talking before the early 2000s. Dividends were treated as ordinary income. And if you historically look at the ordinary income rates, there were some years, looking specifically at the 1940s through the 1970s, where you could have the highest ordinary tax rate 80 to 90%. That's right. 80 to 90% was the highest marginal tax bracket on ordinary income. Now, it's important to note that there was tons of brackets, lots of brackets. So it really had a progressive, the progressive structure, lots of brackets. But during that same time, during the 1940s and 1970s, that was on ordinary income. Long-term capital gains had, during that time, on average, around a 30%, 28 to 30%, we'll just say 30% to keep the numbers simple, 30% max rate. 30% max rate. So think about that. If you have some type of transaction where you could get capital gain, and it's going to be treated as long-term capital gain, right, held for more than a year, 30% rather than 80%, just that lower end of that ordinary, if you're in the highest ordinary bracket, that is a 50% tax savings. So let's apply that to our fact pattern. Let's say we're back in the 1950, and let's say that Blueberry is subject to the highest ordinary tax bracket because Blueberry is already, a medical doctor. So any dividends that Blueberry received, again, qualified dividends were not a rule, were subject to 80% because, again, Blueberry was in that high rate. So that's going to be that Blueberry has to pay tax on $800,000, a million times 80%, $800,000 in taxes. So that's ridiculous, right? Fruit Tree paid taxes, and then Blueberry also has to pay taxes, and it's going to be 80% on that because Blueberry's already maxed out high because Blueberry already has ordinary income. So that brings into play possible strategies that taxpayers took into account. So one strategy is known as a corporate redemption. And when we think of redemption, you should think of a buyback, okay? Think of a buyback of shares. A buyback of shares. Also known as treasury stock, for those of you that may understand or might deal with financial accounting, right? When the corporation buys back its own shares. So think about, right, in this transaction, before and after, Blueberry still retains 100% of the stock. Think about a way that holding aside Section 302, which we're going to be talking about in a few minutes, how Blueberry might be able to avoid ordinary income treatment on this $1 million distribution and get $1 million or even less of long-term capital gains. Well, and also maintain 100% ownership. Well, what Blueberry could do is Blueberry could sell part of the stock, the number of shares of stock, to Fruit Tree, and Fruit Tree in return could pay Blueberry $1 million. Okay, could pay $1 million cash. Okay, so Blueberry is going to sell some shares of stock, and Fruit Tree is going to pay $1 million of cash, and that's how money can get out. Let's say that Blueberry has, to keep it simple, 100 shares of stock, and the total basis in those 100 shares, let's say, is $100,000. $100,000. And Blueberry is going to, so each share, and we'll say they're all equal. So each share has a $1,000 basis. Just keep it simple. Keeping it simple. All right, $1,000 basis, 100 shares. Blueberry is going to sell back to Fruit Tree 10 shares of stock. 10 shares of stock for $1 million. And let's say that value of the stock is actually, that's actually the correct value. Okay? So amount realized. So this is a Section 1001 sale or exchange, right? Sale or exchange. This is a Section 1001 sale or exchange. We're going to apply the normal tax rules. So we have amount realized. This is what Blueberry receives. That's the $1 million. $1 million of cash minus the adjusted basis of the 10 shares. So that's the 100,000 total, but there's only 10 shares. Remember, that was $1,000 per share. So that's going to be $10,000. The adjusted basis in the 10 shares is $10,000. That gives us a $990,000 gain. Okay? What is the characterization of that gain? Let's assume that these shares of stock have been held for 10 years. Okay? They've been held for 10 years. So since it's been held for more than a year, it's going to be long-term, and Blueberry's holding this as a capital asset, so it's a $990,000 long-term capital gain. Compare the results. If Blueberry was subject to an 80% ordinary income rate, the $1 million that Blueberry receives as a dividend will be subject to 80%, $800,000 in taxes. $990,000 subject to a 30% rate. That's significantly less than taxes, right? If it was $1 million long-term capital gain, it'd be $300,000, so it's going to be even less than $300,000. It's probably going to be somewhere around $290-something thousand. So we're talking about saving over $500,000. I'm sorry. Yes, over $500,000. My apologies. Over $500,000 in taxes because we've recharacterized the $1 million as capital, long-term capital gain. Actually less because we're actually able to reduce some of the basis return of capital. So this was a strategy that was used when the ordinary income rates were so high and the capital gains rates were actually a lot lower because historically they've been around 28-30% maximum rate. Now, at the time of this video, even holding aside the ordinary income rates, the highest ordinary income rate is 37%. And when you're watching this video, that might change. So keep that in mind. And the highest long-term capital gains rate is 20% on normal long-term capital gains. So you're only talking a 17% difference, which isn't as big of a deal breaker as 50% difference like you have here. But still, 17%, if that's on $1 million, it's $170,000 in taxes you're saving. Still a big deal. So the question is this really allowed? Because we've done pretty much the same thing. We've gotten out $1 million and still maintained ownership 100%. Why? Because now B owns 90 shares of stock and there's only 90 shares outstanding because Fruit Tree has bought back 10 of those shares and they're no longer outstanding. So Blueberry still owns all 90 shares that are outstanding. So Blueberry owns 100% of the corporation and still controls it the same way. So economically, nothing's changed. So can this be done today? And the answer is we have to look at Section 302. 302 deals with the tax consequences of redemptions. And what you're going to see is that under Section 302, a redemption has one of two possible treatments. The first possible treatment is that it will be treated as a sale or exchange under Section 1001, just like we saw here, or it'll be treated as a a distribution under Section 301. Okay, sorry. Distribution. I know. I always am tempted to do that. Remember that under the tax law, distribution and dividend are not the same thing, but financial accounting, a lot of times they are. They can be under the same thing for tax law if EMP is enough. Distribution, which we apply the rules of Section 301. Section 301 distribution, and we go through the waterfall, right? The Section 301 distribution rules. We go through that waterfall. So the question becomes, how do we know whether it's going to be sale or exchange and we apply Section 1001 or it's treated as a distribution? We apply Section 301 and apply the three-part waterfall. The way we know this is that we have to go through a checklist and focus on 4 parts. So at this point, we're now going to look at that checklist. And we're going to focus on those 4 different tests. If you meet one of those 4 tests, it's going to be treated as sale or exchange. If you don't meet any of those 4 tests, guess what? It's going to be a Section 301 distribution. All right, so now we're at the checklist. This is the redemption of stock general considerations checklist. Anytime that we have a redemption, again, a buyback of shares by the corporation, which is what we refer to as a redemption under the tax law, we need to consider the consequences. So the first thing is, should the redemption be treated as a sale or exchange or a distribution? So again, whenever we have this redemption, there's one of 2 possibilities. Sale or exchange treatment under Section 1001 or distribution. So Section 302 is where we focus on this. Section 302 distinguishes sale type redemptions or sale or exchange, which Section 1001 applies, from distribution type redemptions. Now note that Section 318, the attribution rules, apply for purposes of applying Section 302. We'll talk about those rules in a second. If the redemption is treated as a distribution, see the corporate distributions checklists. So we've looked at those before. That's the distributions checklist where we go through the 3-part waterfall for the shareholder, the 4 steps, right? Step 1, look at the consequences of the corporation. Step 2, adjust current EMP for step 1. Step 3, we look at the consequences of the shareholder, the 3-part waterfall. Step 4, we adjust accumulated EMP for the corporation for next year. So we apply those same checklists if we determine that Section 302, the 4 tests, any of the 4 tests do not apply, which we're going to look at in a moment. Is the shareholder, so the next question, is the shareholder an individual or corporation? The reason why that's important is because there's something out there, you might remember, for corporate shareholders, we have to worry about the dividends received deduction. Generally speaking, anytime we have a distribution or redemption and you're a corporate shareholder, the corporation wants it to be treated as a dividend, not just a distribution, but a dividend. So thinking from a planning standpoint, corporate shareholders that receive stock from another corporation, they want it to be treated as a distribution and therefore a dividend, getting dividend, so they can get that DRD. Because if it's not a dividend, you don't get the DRD, the dividend received deduction. Individual shareholders, of course, just like the example we saw earlier, they almost always prefer Section 302 for two reasons. Because of return of capital, right? You get to reduce basis for the number of shares of stock that are sold back to the corporation. And, so that's the first reason. The second reason is because if you hold the stock for long enough, it's going to be long-term capital gain or long-term capital loss that you actually can utilize. Okay? Let's continue. Number 3 in the checklist. How can a shareholder qualify for sale or exchange treatment when you have a redemption? So the way this occurs, we look at Section 302B. There's 4 different possibilities, 4 different tests. If you meet any of these 4 tests, then the redemption is treated as a sale or exchange. Section 1001, sale or exchange. So these tests, which we're going to do not in this order, but this is in the order in the code. 302B1, B2, B3, B4. Okay? Actually, I'm sorry. My apologies. This is the order that we're going to do them. Take that back. This is the order that we're going to consider them. We're going to go in this order. Okay? This is the order that we consider. And I'll explain why as we go. But this is not how you find them in the Internal Revenue Code. Actually, redemption, not essentially equivalent to a dividend, is actually the first one. That's 302B1. But that's actually going to be the last on our list, and I'll explain why. Okay? So continuing on, so again, if you meet any of those 4, you have a sale or exchange. If you don't have any of those 4, guess what? It's going to be treated as a distribution. That's the way this works. And you apply the 301 distribution checklist. What are the tax consequences to a shareholder that receives a redemption that qualifies as a sale or exchange? So again, sale or exchange. We're going to apply Section 1001, okay? Section 1001 applies, right? That's the amount realized minus the adjusted basis. And for virtually all shareholders, you're going to have a capital gain or capital loss, right? Because the character of the stock is almost always capital unless you're a broker dealer. If you hold it for more than a year, it's going to be long-term, a year or less short-term. Okay, we look at all of those things. And that gives you long-term capital gain, long-term capital loss treatment. What happens if you are, what happens if you have a redemption that does not qualify for sale or exchange? Does not qualify for sale or exchange, meaning that's going to be Section 301 distribution. Well, in that case, you apply the corporate distribution checklists, right? You go through the 4 steps. You apply the corporate distribution checklist. Any basis of shares redeemed that is not used as a result of Section 301 distribution will be reallocated to the other shares. That's very important. You're going to see that in problems later on. So you don't lose any basis. It just gets reallocated to the other shares. So in our example we saw early on with Blueberry, right? We had 100 shares, $100,000 basis. If that $1 million amount is treated as a distribution amount and not a sale or exchange, then that base is $100,000. Instead of being allocated over 100 shares, gets allocated over 90 shares, which means the basis is going to increase. So we'll see examples of that later on. What are the tax consequences to a corporation that redeems some of its shares? So the consequences, whether it falls sale or exchange or falls as a distribution, make no difference. They make no difference, okay? But one thing that does change is the earnings and profits. Those do change the consequences, whether it's distribution or not, okay? So the actual consequences stay the same, all right? The rules are similar to the tax consequences of the corporation distributing cash or property that falls under Section 301. The idea there is that if you have appreciated property, the corporation recognizes gain, even if it's going to be property that's being exchanged for shares of stock. We still have to worry about step 1 and step 2 affecting that, lost property, all that stuff. The difference, though, is that when it's a distribution, we already know how to calculate EMP for the corporation going forward. That's under step 4 of our distribution checklist. But what if we're doing a redemption that's a sale or exchange? So that does have a big difference. And I have summarized the rules here for you. You need to know these. Very different. If the corporation distributes cash and it's treated as a sale or exchange, okay, EMP is reduced by the amount of cash, okay? So we're dealing with redemptions again. So again, the consequences don't change for the corporation, whether it's a sale or exchange or a distribution. But EMP does, so the consequences are similar to that of a distribution or distribution checklist, but for EMP going forward, that does change. So if the corporation distributes or pays out cash in the redemption, sale or exchange, or distribution, EMP is reduced by the amount of cash. If the corporation distributes appreciated property, EMP is reduced in an amount that may not exceed the ratable share of accumulated EMP to the redeemed stock. So basically, this is going to be a pro rata portion for the shareholder, okay, and adjust the corporation with respect to the shareholder. So with respect to the shareholder that's making the that's involved in the transaction. Okay? If the corporation distributes lost property, EMP is reduced by the basis. So the key difference here, the first one and the last one, those are similar to the distribution rules that we learned in the corporate distribution checklist. But this one right here, this is where you see change. So if it's appreciated property that like land or building that's appreciated in value, we only are going to reduce EMP by the ratable amount that exceeds the accumulated EMP pro rata with respect to the shareholder. So that's a big difference. Okay, so now that we've gone through all this, we're going to focus on those four different tests, okay? The 4 different tests. And we're going to talk about those in order again, starting with substantially disproportionate, then talk about complete termination, partial liquidation, and then the final one is not essentially equivalent to a dividend, NEED. If you have any of those 4 tests, you have in these redemption transactions, you have sale or exchange. If you don't have one of those 4 tests, if you fail all 4 of them, you have a distribution that's subject to the corporate distribution checklist. Before we go into those tests, it's important to note that Section 318 attribution applies. Okay? When determining whether a shareholder's redemption qualifies under one of the 4 tests in 302B, it's important to look at the constructive ownership rules under Section 318 attribution. So the idea is that we have direct ownership in a corporation, because a lot of these rules deal with the ownership percentages, plus the indirect or constructive ownership, indirect ownership. So you're wondering, or you're asking, what exactly do I mean by indirect ownership? So you might recall from Section 267, the related party rules. Sometimes when a party owns stock in another corporation or another entity or has family ownership, they're viewed as related. We apply similar ideas here when it comes to ownership. So the first one is family attribution. Family attribution, again, direct ownership is what you directly own, but if you have any family members that are listed here and that are specifically in 318A1, which I have listed here, you are also viewed to own their percentage ownership as well. So this specifically applies to the spouse, children, grandchildren, and parents of the shareholder. Legally adopted children and half children, all those things are also treated like any children. So the idea here is we have lineal, but it stops. It's not very broad in terms of who all is included. Okay. So if we have a taxpayer, right? Let's say we have taxpayer, we have B, right? Which was our shareholder. We go up to the parent. Okay. We go up to the parent. We go up 1 level to parent. Okay. To the parent level. We go down 2 levels to child and grandchild. Okay, 2 levels, right? Go down 2 levels. Let me draw that a little better. Okay? So we've got parent, we've got child, we've got the child, and then we have the grandchild. Just put GC, grandchild. Okay, so again, we're looking at our taxpayer B. And then B, Blueberry, also the spouse. So Blueberry's spouse. Also have to worry about the spouse. Okay? Also the spouse. Write that a little better, sorry. So Blueberry's spouse. You also have to worry about Blueberry's spouse. Okay? So we've got the parent, we also have child and grandchild and spouse when you look at going over. All right? Notice it does not include grandparents, doesn't include cousins. This is all includes. So it's actually a very narrow definition for family attribution. All right, other types of attribution. Attribution from entities to investors. Stock owned directly or indirectly by a partnership or estate is considered as owned proportionally by its partners and beneficiaries. So you actually are going to use the percentage ownership in that entity and multiply it by however many, whatever percentage ownership that owns. So if Blueberry owned 50% of a partnership that owns half of another corporation, it's going to be 50% times 50%, so 25%. Half of half is 25%. Half of 50% is 25%. If a shareholder directly or indirectly owns 50% or more of the stock of a corporation, stock owned directly or indirectly by a corporation is owned proportionately. So anything less than 50% is not going to be viewed. But anything 50% or more is proportionate. So notice that partnerships and estates, it's any percentage, whether it's 1% or 99.9%. But for corporations, it has to be 50% or more to actually be viewed as proportionally owned. Okay, and note that this attribution is considered a proportion of ownership. Attribution from investors to entities. So if you're looking at an entity and what they own, then we have stock owned directly or indirectly by or for a partner or beneficiary is considered owned by the partnership or estate. So if you're looking at here, not Blueberry, but maybe some specific entity that Blueberry owns, and that's the taxpayer at issue. Okay, that's the taxpayer at issue. Then the idea there is attribution from investors to entities. We're specifically focusing on that. Stock owned directly or indirectly by partner or beneficiary is considered as owned by the partnership or estate. If 50% or more in value of the stock in a corporation is owned directly or indirectly by or for any person, the corporation is considered owning the stock by that person. So it has to be 50% or more. For partners or beneficiary in a estate, it's just whatever it is. Now notice that this is not proportionality, it's just the entire amount. Okay? And I noted that here. I noted that here, and also it's noted here. Notice that big difference. So again, attribution from entity to investor, so that would be Blueberry. If we're looking at Blueberry's ownership, that's going to be proportionality. Okay, proportionality. But if we're looking at the entity that Blueberry is an owner in and what ownership the entity has, it's just going to be the amount. The amount. Options. If a shareholder, constructed person, entity has an option to acquire stock, that stock is viewed as considered owned by that person, even if the option is not yet exercised. So that is the attribution rules. Very important to understand. Let's go ahead and go through the 4 possible tests or steps. If you meet any of these 4 tests or steps, then you have a sale or exchange when it comes to redemption. And the reason why we go in order, starting with substantially disproportionate, is that we go in the order of really mechanical tests to the most subjective. The first 3 tests all are somewhat mechanical. The last test, though, is definitely subjective. So the first test is known as the substantially disproportionate test. The substantially disproportionate test, found in section 302B2. Okay, so this test really has 3 things that have to be met. So all 3 requirements must be met, and it's a fully mechanical test. There's no other way around it. Again, remember, all these tests, we're applying the family attribution rules. So the first thing, the first part of this test is that after the redemption, the shareholder must have less than, not less than or equal to, less than 50% of total combined voting power of all classes of stock entitled to vote. Second requirement, after the redemption, the shareholder must have less than 80% of the voting stock of the shareholder's amount before. So what we do is we take the amount before the before ownership percentage, we multiply that by 80%, and we're going to use that number for number 2 and number 3 in terms of these requirements, which all 3 have to be met. So again, the first one here, the second requirement is that after the redemption, it must be less than 80% times the before percentage immediately before when you're looking at voting stock. And number 3 is must have less than 80% of the before percentage of all classes of stock, voting and non-voting, held immediately before. Okay? So the difference between 2 and 3 is 2 is voting, 3 is all classes of stock. All classes of common stock. Okay? Not preferred stock, common stock. So 2 is voting, 3 is all common, non-voting and voting. And again, it's that before percentage. Has to be less than before times 80%. The new percentage does. So that's really all that test is. The best way to illustrate that is to go through some examples, which I have for you to look at later on. Okay? If you meet that requirement, if you meet all 3 of those tests, boom, you have sale or exchange treatment. If you don't, if you fail any of those 3, then you move on to step 2. So step 2 is the complete termination test. Complete termination, as it suggests, means that you are going to not own anything directly plus indirectly after the redemption, after this buyback. In order to meet the requirements, you have to have a complete redemption and there's no ownership. This is actual and constructive. Actual and constructive, you must be 0. So you're saying, well, wouldn't that also fulfill the requirements of the substantially disproportionate test? Because you would meet all 3 of these different tests. And you're right, because you would have less than 50%, and then your before percentage times 80%, your after percentage would be less than that if you're at 0. So you're right about that. It would be. However, the issue is that what if you have some indirect ownership, constructive ownership, whether it's through family members, which usually it's a family member issue is what we're focusing on. Well, then you could fail potentially any of these 3 tests when you apply the constructive attribution rules or the attribution rules constructive ownership. The key here, though, is that under the complete termination test, there's potential for a waiver of family attribution under section 302C2A. Okay? 302C2A. Now, the key is that the waiver rules, you have to meet certain things. This is a special rule that only applies to complete termination. That's why we have this rule and we have the other rule as well. A redemption that terminates actual interest in a corporation will be treated as an exchange. Okay? And we have a waiver. All right? Immediately after the redemption, shareholder retains no interest in the corporation other than as a creditor. A shareholder must have no interest in the corporation as shareholder, officer, director, employee, or independent contractor. The shareholder does not acquire any such interest other than by bequest or inheritance within 10 years from the date of distribution. If violated, the waiver will be invalidated retroactively. Go back to it, those years, and that year of that return, and be treated as a distribution. The distributee, that should say, files an agreement with the IRS to notify it of any prohibited acquisition described and to maintain records. So that is how we get the waiver. So the idea here is that the shareholder retains no interest in the corporation and has no interest in terms of being a shareholder, officer, director, or key employee or independent contractor. The idea is that if your ability to exert control is still there, right? Control as some type of person, then you have issues with respect to your family members, okay? And then you obviously are filling out these forms, so it's more formal, okay? That's the idea. You can apply for that waiver. And then if you have family members that own, you can actually still potentially be viewed as not owning anything, even though you have family members that own, that qualify as constructive ownership. So that's the special rule there. If you have that waiver, okay? Complete termination, waiver is possible. That could potentially take out the family member's ownership. So if we don't have a complete termination, we continue. We go to step 3, which is the partial liquidation. So partial liquidation, redemption, basically means that, and this is under 302B4, means that the corporation is going to liquidate eventually, and a partial liquidation is taking place, and that's what this redemption is. So here's what has to be met. The stock is held by a person other than a corporation. The distribution is in partial liquidation of the distributing corporation, which meets all the following criteria. There's a plan that's been created and occurs within a taxable year in which it's adopted, and certain activities, and I'm not going to go through these, you can read these, but there's this 5-year rule, certain activities are going to cease and whatnot, certain lines of business, or actually the entire business, all these different types of things, okay? This rule is not as common as you would think. Complete termination and substantially disproportionate, a lot more common, so I'm not going to spend much time on the partial liquidation. Just know that it's possible that you can get a sale or exchange treatment through partial liquidation. If we don't meet that test or the other tests, then finally the last test. This is our last resort. Step 4 is our last resort. And the reason why it's the last resort is because unlike the other tests, there's lots of subjectivity with this test. It's factors test. There's lots of subjectivity. This test is found in section 302B1. It's called the not essentially equivalent to a dividend test. Now, the idea again is that if you have a redemption, it's either treated as a sale or exchange or a distribution, right? Which could ultimately be a redemption. A dividend. So, not essentially equivalent to a dividend. So, really saying not essentially equivalent to a distribution. And if you have EMP, that would obviously be a dividend, okay? So, this is the last resort. And the idea here is it's subjective. It's subjective. Now, before Section 302B1 was codified by the Internal Revenue Code, by Congress, there was a case, United States versus Davis. In this case, we have issues of redemption. And what happens is the court focuses on a meaningful, this is the important language you need to know, a meaningful reduction of the shareholders' proportionate interest in the corporation, which really ends up becoming a meaningful reduction in control where the key factor is the voting power. Okay? Meaningful reduction of a shareholder's proportionate interest in the corporation, and we focus on the meaningful reduction in a shareholder's voting power or control. That's what we focus on. Okay? Now, this can be very subjective, but there's really 2 revenue rulings that we always learn when it comes to corporate tax that you need to know. Okay? And they kind of illustrate kind of the ideas behind things. And I have some problems that will walk you through these specific revenue rulings in more detail, how they work. So I'm just going to describe them there. So we have revenue ruling 75-502. So in this revenue ruling, a corporation has 2 owners. That's going to be key because there's going to be a question, right? There's going to be a question. What if you have more than 2 owners? You have more than 2 owners and you have a similar situation. This is a more than symbol, sorry. More than 2 owners. And what if you have a similar situation, but it's more than 2 owners? So in this situation, an owner was held to have significant loss of control or reduction, meaningful reduction in control, when the ownership dropped from 57% to 50%. So let's think about a few things. Again, this is the last test. If we went through the other tests, right, we wouldn't meet the first test, substantially disproportionate. Can you take a second, maybe pause the video and think why in this situation, if a shareholder goes from 57% and then the corporation buys back shares and now the shareholder owns 50%, why would you fail the substantially disproportionate test of Section 302B2? Take a second to think about this. Well, the answer is, the first test, you must have less than 50% ownership after the redemption. Here it's exactly 50%. We fail the first test. It's not complete termination because we have 50% ownership. We don't have a complete termination. Our direct ownership is more than 0. Can't have complete termination. Nothing here about partial liquidation. As I mentioned, that's kind of rare. So the only thing left here is a meaningful reduction in control. So this shareholder, if you think about it, right? Let's say we have A and B. We have our blueberry and we have A. A and B, 2 individuals. A and B. A owns 57% and B, let me redraw that circle. B owns, so A owns 57%. B owns, sorry, it's a percentage symbol. 57%, and B owns 43%. Okay? So if you think about kind of the decisions that corporations have to make, right? Maybe you have an online business that's maybe not all online. Maybe it has brick and mortar stores. Maybe a type of decision that shareholders have to vote on is whether we cease all brick and mortar stores and we do online only, right? Think about something like Walmart, a company like corporation like Walmart. Started off as a brick and mortar, started moving more and more online. Maybe a decision's made eventually, hey, let's close all our brick and mortar stores and let's just go online. That would have to be a vote that only the shareholders could vote on. Not the board of directors, not the managers, not the CEO, have to be the shareholders. It's so integral to the business because they're a retailer. So if this business had a similar issue, they're thinking about closing all the brick and mortar stores and just do all online because right now they have both. If whatever A wants goes, because A has 57% of ownership and control, okay? So that if A wants to close all the brick and mortar stores and just do online, A wins, boom, because A has more than 50% ownership and voting power. But what if A goes from 57% to 50%? Now A owns 50%, B owns 50%. If we vote, A wants to close, but B doesn't, guess what? We're at a stalemate and we can't make the decision. So that is a meaningful reduction in shareholders' voting power or control. That makes a difference. So here's a general rule. Once a shareholder's voting power drops equal to or below 50%, his or her ability to control the corporation certainly can be jeopardized. So you have to think about the specifics of that fact pattern. So I mentioned earlier, what if you have more than two owners? Well, it's possible that if we have A, B, and C, right? A, it might be able to team up with B or C, and they might be able to do that. But if you have one shareholder, that's different because if you have specifically A and B always butt heads, you're never going to be able to come to an agreement when you have 50-50. But if you have A, B, and C, A and B butt heads, but with A plus C, you can get a vote. That makes a difference. Okay? And we're actually going to see that in the concert issue in a moment, the next revenue ruling. So you have to think about that. But it's clear here that when A goes from 57% to 50% with two owners, boom, that's a meaningful reduction in control. I would generally say that most situations, not all, but most, when a shareholder goes from the ability to control by themselves more than 50% to equal to 50% or less, that is viewed as a meaningful reduction in control. Not always, but most of the time. Let's consider the other revenue ruling. Okay. By the way, here's the uncertainty I mentioned. What happens if there's more than two, right? Or it depends on the facts and circumstances, right? Different facts and circumstances, A could team up with C, all these different things. Again, I just mentioned that. The uncertainty, that's why this not essentially equivalent to a dividend issue is always the last one because there is some subjectivity involved. Okay, some subjectivity. Okay, so let's consider the other revenue ruling. We talked about the first one. Here's the other one. So in revenue ruling 76-364, a corporation has four owners that are all unrelated. Okay, we have A, B, C, and D, and they're all individuals. Okay, so one shareholder owns 27%, that's A. B, and the other ones own between 24 and 25%. Okay, so we'll say that B has 25%, C has 24%, and D has 24%. Let me make sure those numbers equal out here. We got to have the right percentage, right? We have 25, we have 27 plus 20, 52. That's right, okay? So this is a 24. This is a 2 right here. Let me rewrite that. Okay, 24 for D. And it equals out to 100. If you add all that's up, 27 plus 25 plus 24 plus 24, boom, we got 100. That's right. That's at the beginning. So this is before the redemption, okay? Before any redemption. A has 27%, B 25, C 24, D 24. Thinking about, again, the ability to control and vote. This is the voting percentage. If A teams up with any one person, B, C, or D, what does A and that person have? They have majority control. Think about it. 27 plus 25, 52%. 27 plus 24, 51%. 27 plus 24, 51%. If A teams up with any one person, B or C or D, doesn't matter, because B and C might hate A, but D might love A. A and D can get together and they can vote on that, closing down that online operation. I'm sorry, closing down the brick and mortar and doing all online. Okay? But notice, unless the other shareholders team up with A, they do not have the ability to control. So look, you just run the numbers. B plus A is 52, but B plus C is 49. B plus D is 49. C plus A is 51. C plus B is 49. C plus D is 48. So unless C teams up with A, B teams up with A, or D teams up with A, we have that's the only way they can get control is if they specifically team up with A. But if they team up with any other person, they will not have control. Now, if they team up with more than one person, two people, yes. If B, C, and D all hate A, they can of course group together and be more than 50%, and A is stuck with 27. But we're talking about the ability to control in concert with just one person. So this specific situation, that was the before. Okay, there was a redemption of A's shares, and A went from 27% to 22%, and it increased B, C, and D's percentage ownership. After that, A no longer could team up with just one person to control. So the ruling is that this was viewed as a meaningful reduction of control because A, again, has the ability to team up with one person in concert, but after this could not do that. There was not any person that A could team up with. Very interesting. So A has less than 50%, 27%, but A can still have a meaningful reduction in control because before A could team up with one person, now A cannot team up with just one person to control. By the way, if you run the numbers on this, it would fail substantially disproportionate because of the 80% test. It'd have to be before times 80%, 27% times 80%, I think is in 21 point something. Okay, so it would have to be less than that 21 point something, which 22 is of course more than that, so it would fail to less than 80% before percentage. So this is viewed as a meaningful reduction. So the general rule is that if all of the following conditions are met, right? We have this: if the owner with the redemption will be treated as having significant loss of control due to a loss of control in concert. That's the key with others. Okay. So the key here is that this revenue ruling applies to four owners. The one owner could team with any other owner, and then afterwards cannot team with any owner. So again, you can play with the facts, and then there's going to be questions that arise, and that's why this is subjective. Like, what happens if you have more than four owners? Or what happens if A gets to a position where A can team up with some people, but not everybody, but before could? That results in a bunch of open areas. I'm just focusing on you knowing these revenue rulings and how they work, because you're going to see problems later on that focus on the revenue rulings. Okay. So if we meet this not essentially equivalent to a dividend, boom, it's sale or exchange, or any of the four tests. Once you meet any of the four tests, boom, it's sale or exchange. If it's not sale or if you fail all these four tests, it's going to be treated as a distribution, and we go through the corporate distributions checklists. Okay? That's the idea. The corporate distributions checklist. All right, so we now have gone through everything. We've gone through the ideas behind the redemption. What's the big deal from a tax standpoint, right? Remember, ordinary income rates versus long-term capital gains rates. People were playing games. Congress came with Section 302. We also talked about where you're for different types of shareholders, like corporate shareholders versus individual shareholders might have different preferences. We talked about the whole idea of how it works, sale or exchange versus distribution. We talked about the effect on the corporation. We also went through the four tests. So the problem videos I have on these topics focus on the four problems. They focus on the problems, with the exception, I don't really have anything on partial liquidation because it's kind of rare. But I do have stuff on the substantially disproportionate test, the complete termination test, and of course, not essentially equivalent to a dividend, NEED. Okay, so make sure you watch those problem videos because it really helps you understand. So I hope that you've enjoyed this video.